Hey everyone, welcome to another episode of ADMAIL. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, welcome to another episode of ADMAIL. I'm Adam Bergman, tax attorney and founder of IRA Financial. On today's podcast, three incredible questions. One involving 401ks and an S Corp. The other discussing the difference between a plan administrator and a third-party administrator. And then the final question talking about contribution deadlines for a single member LLC for their 401k. So really great, interesting, kind of a solo 401k focused type podcast, but this is a good one. I'm really excited about today's podcast. So without further ado, let's get started. First question is from Lisa F. of Lincoln, Nebraska. Lisa wants to know, can I set up a solo 401k for my S Corp if I am the sole owner? Am I considered self-employed? So the answer, Lisa, is yeah. This is a misconception that people think that you have to be a sole proprietor to be self-employed. You don't. You just cannot have any full-time employees other than the owners, shareholders, or their spouses. So it could be a C Corp, an S Corp, a partnership, a single member LLC, and of course a sole proprietor to determine if someone's self-employed. So I get this question all the time, Lisa, saying, I have a sole proprietor, I have an S Corp or a C Corp, and I want to set up a solo plan. Like, do I need to terminate the entity and just be a sole proprietor? The answer is no, you're self-employed. The solo K is designed, whether you're a sole proprietor, an LLC, C or S, doesn't matter. You just have to have your own business with no full-time employees, someone who works more than 1,000 hours or 3 consecutive years of 500 hours or more, and spouses do not count as employees. So if it's just you and your spouse is an employee, you're still self-employed for solo 401k purposes. So it's a great question, Lisa. That's why I wanted to include it. Some people may think it's basic, but a lot of people get confused and they just kind of think that self-employed has to be a sole proprietor. Second question is from YouTube, and this individual wants to know, I have a solo 401k with IRA Financial. Good, smart person. What's the difference between a plan administrator and a third-party administrator? So that's a great question. A plan administrator is generally the business. So when you file a 5500 EZ, which is the annual filing requirement for the plan, if they have more than 250K in asset value as of 12/31, the plan administrator is the business. That is the party responsible for making sure the plan is in full compliance and handles all IRS reporting, whether it's 5500 EZs, 1099, restatements, whatever is required to keep the plan in compliance. A TPA, or third-party administrator, is generally a third-party company that the plan administrator, will hire, like IRA Financial or Pension Investors, which is a TPA company that I'm also involved in, been around since the mid-70s, literally from ERISA. And they have more expertise in defined benefit plans, cash balance plans, more complex defined contribution plans. They also do solos. They're an amazing, brilliant company. They're a TPA, right? They make their money on doing administration. They don't sell investments. They don't sell products. They don't give investment advice. They do all the boring IRS work. So 99% of all companies do not want to do it themselves. In the solo 401k world, IRA Financial is the TPA. So most of our smart solo clients will have us do the annual filings, whether it's the 5500 EZ, 1099Rs, there's restatements, we handle it. Why? It's just not worth their time to do it themselves. Like, we charge $400 a year, $399. It's like, if you're running a business, like, you just don't have time to mess around for $400. Just have an expert do it when there's no issues. So that's what the TPA world is. The company that adopts the plan, the adopting employer, but also the plan administrator. If you have a sole proprietor and the business is Adam Bergman, you have to get actually a tax ID number for your sole proprietor business to be the plan administrator, because it cannot be an individual. It has to be an entity. So most solo Ks will just have a TPA like IRA Financial, our TPA service, or another company handle the annual administration. Just so much easier, cleaner, and less risky. Third and final question on today's episode is from Twitter. And this individual wants to know, can I make solo 401k contributions for my single member LLC in March 23 for the 22 taxable year? So the question is March 23 for the 22 taxable year. The single member LLC is not required to file a tax return until April 15th because it reports income on a Schedule C or losses, and an extension October 15th. So here's the answer. If you had your plan in existence before 23, then yes, you can do employee deferrals and profit sharing contributions at 20% up until April 15th. And if you get an extension on your 1040, up until you file latest October 15, 2023. If you have not set up your plan in 22, you're setting one up now with us, then you can still do contributions for the 22 year in 23 up until April 15th or October 15th with extension, but only the 20% of your net Schedule C, not the employee deferral. So let me explain. When you make contributions to a solo K, there's two categories. There's employee deferrals, 1, 2, profit sharing. Employee deferrals in 2022 is $20,500 if you're under 50, $27,000 if you're over 50. That can be in pre-tax or Roth. Okay, and then the employer profit sharing is 20% of your net Schedule C. So if you made 100K, you can do 20% profit sharing plus 20,500 or 27,000 if you're over 50. If you set up your plan in 22 or before, then you can do the employee deferral and the 20% up until you file your return, whether it's April 15th or up to October 15th. If you have not filed your plan, if you haven't set up your plan yet in 22 and you're setting it up now with us in 23, that's still good. You can do the 20%, but you cannot do the 20,500 or the 27,000, just the 20%. That rule is going to change. So starting next year in 24, you'll be able to do for the 23 taxable year, employee deferrals and profit sharing up until you file your return, even if you haven't set up the plan, which is awesome. It's just this is the last year where only the employer contributions can be done if you haven't set up your plan in 22. If you set up your plan in 22 or before, then you can do both the employee deferrals and the profit sharing for your single member LLC up until April 15th or October 15th with extension. That's it. I hope you guys enjoyed today's podcast. Keep them short and sweet. That's why these podcasts are so much fun. You get really good, detailed, precise information. Hopefully you get to enjoy the questions. I think they're really good. They're not from me, they're from clients, so they better be good. And we get to learn together. So thank you for listening. If you're watching on YouTube, much appreciated. Don't forget to thumbs up, give it a like, and subscribe to our amazing YouTube channel. There's tons of amazing content. 3 to 4 videos and 3 podcasts a week. So there's literally almost something dropping every day of content involving self-directed retirement accounts, taxation, current events, case law, really cool stuff. If you're just like want to become a better, smarter IRA or 401k investor, I think you'll enjoy channel. I know you will. So other than that, thanks for spending some time with me today. Super appreciate it. And I'll see everyone again next week. Ciao. Take care.